Hey all, welcome to question 4 of the FIN317 main exam. So let's skip ahead to the question, see what the question is about. So, number 1 is, so it's split into 2, so there's 10 marks in part 1. So it's identify and explain the errors in the draft goodwill calculation in relation to the consolidated financial statements. Okay, so it's to do with the goodwill calculation, and if you see the words goodwill, you know it's business combination. So it's to do with acquiring businesses, and then the goodwill calculation is basically summing up all the assets and liabilities, reducing the NCI, adding the fair value and contingent liabilities, and then looking at the difference between the consideration and those assets, or the fair value of identifiable net assets, and the difference is goodwill. So this is an unusual question in that we have to actually look at the calc and figure out where the errors are as opposed to preparing it ourselves. And it says specifically we do not have to prepare an amended calculation. Alright, so let's quickly skim over the background information. So Otway is the company. They're purchasing 60% of Kilconda on 30 June 2016. The tax rate's 30%. So at the acquisition date, the recorded net assets of Kilconda were represented as follows. So 3 million of share capital, 8.5 million in retained earnings, total equity of 11.5 million. So except for inventory, Kilconda's identifiable assets and liabilities at acquisition date were recorded at fair value. Okay, that's good. So all of that's fair value. The inventory's fair value was 600k, but was recorded at a cost of 200k in Kilconda's records. There was an unresolved legal claim against Kilconda at 30 June 2016, so we're going to have to include that in the calc. A competitor claimed that its registered design is being used by Kilconda in the manufacture of its surfboards. Kilconda's lawyers believe it has an 80% chance of successfully defending against the 80% claim, against the 1 million claim. Kilconda would need to pay 300,000, which would be tax deductible for Kilconda, for a third party to assume responsibility in respect of this claim. The following consideration was transferred to obtain the controlling interest in Kilconda: a cash payment of $2 million, the issue of 2 shares in Otway for every 1 share acquired in Kilconda. Otway's share price at the acquisition date was $1.80. So we might have to do a script for script calculation. Other acquisition information: Otway uses the partial goodwill method to calculate goodwill. Additional information post-acquisition: Kilconda's inventory held at acquisition was sold in August 2006 for $600,000. Due to adverse developments in the legal cost in the legal case, Kilconda decided to settle the claim with its competitor and paid damages of $500,000 in November 2016. So is that an adjusting event? You are the financial accountant reviewing the work drafted so far and preparing the consolidated financial statements. And here is the draft goodwill calculations. So do we need to do a quick recap from the FIN notes? If you look at business combinations, there's a good table in here that we can refer to just as a recap. Where is it? Okay, maybe it's not in here. That's okay. Maybe watch the video on it in the core key content down below if you want to understand more around the background as to the goodwill calculation. But for now, let's just focus on answering this question. Okay, so the first thing that I would do is probably just do a logical sense check of this calculation. Now we're looking for probably we're probably looking for at least 5 errors, with 1 mark being the error and 1 mark being the explanation. But maybe I'd probably suggest doing 6 just in case. Or if there is more than 5, then I'd probably include 6 if there is that many. Okay, so the first thing is I just do a logic check of what's going on. So to just break it down, we're buying 60%, was it? 60% of this company. Okay, so that might potentially be something's wrong where they might have recorded something at 100%, whereas we should be only recording it at 60%, for example. So that's something to look out for. So we should, except for inventory, the identifiable assets and liabilities at acquisition date were recorded at fair value. So there may need to be an adjustment for inventory to fair value, which may not be in here. It's something to look out for. because if you look at the exam Bible to the right, you can see all the steps we need to take. We need to consider consideration first of all, so the contingent consideration, the deferred consideration, the value of NCI, and then we need to, on the other side, we need to adjust for the assets. So we need to take the book value of net assets plus the fair value adjustments plus internally generated intangibles less contingent liabilities, and that equals to fair value of net assets, and then the difference between consideration fair value of the Favina is equal to goodwill. Okay. All right. What else? There might be some adjustments in here for the sale of inventory and potentially the legal case as well. So let's have a look. So first of all, the cash and the consideration. So the cash, let's just sense check the cash. So we can see with the following consideration was transferred to obtain the controlling interest in Kilcunda, a cash payment of $2 million, so that makes sense. But they also, the issue of 2 shares in Otway for every 1 share acquired in Kilcunda. Otway's share price at the acquisition was $180. So really, the calculation should be, okay, so the number of shares there are, so there's 3 million, but we're only acquiring 60% of them. So shares 1, 2, 3, 1, 2, 3. There's 3 million shares. 60% of those. of those shares is equal to 1.8 million. And the price of those shares is equal to that times 180, 3.24. So let's have a look at what it says down here. So shares issued, dollar value. We're saying here 10.8 million. Okay, so there's the first issue there, is that the number of shares issued, they're saying it's at, oh sorry, we also need to do it times 2 because it's 2 shares times 2. So they're saying it's 10.8 million, but in reality what they've forgotten to do is take out the 40% non-controlling interest. So that's the first issue right there. So issue number 1 is shares issued, and the explanation is that the calculation has incorrectly included the number of shares that are assuming 100% acquisition when it's only a 60% acquisition. So they need to remove the 40% component from the 10.8, equaling 6.48 instead of the 10.8 million. Okay, so we don't need to prepare an amended calculation, we can just make comments on it. So that's the first issue. Okay, let's keep going through. So line by line. So non-controlling interest at fair value. The fair value measured at 30 June 2017. So when did we buy this business? Because normally you're meant to do all of this at the date you bought the business, not at the reporting date of the financial statements. This is all prepared at 30 June 2017, but we bought the business in August. Sorry, when did we buy this business? We bought the business on 30 June 2016, but we're reporting this at 30 June 2017. So that's the second issue, is that the NCI was measured at the in the current calc, the NCI is measured at 30 June 2017 when it should be measured at the acquisition date of 30 June 2016. So that's the second issue. Okay, so the non-controlling interest NCI is valued at fair value. Okay, so having a look over here at the business combinations notes, it tells you here that if it's using the partial goodwill method, it should be calculated on the percentage of Favina, not the fair value of the non-controlling interest. So there's 2 different methodologies there. So the fair value of net assets, if we do a quick calculation, is equal to, actually let me just write the previous issue, timing of recognition of NCI. Okay, that's the second issue. Third issue is So if we calculate for Vina, it's 11,710 according to this. Now the non-controlling interest is 40%. Therefore, the NCI in partial goodwill should equal to 4684, which is different to what's listed there at 350. So there's the third issue right there. Okay, so moving on. The carrying value of net assets. That's fine, it's not going to change. Okay, so the contingent liability down here. So the first issue I'm seeing is they're adding the contingent liability, right? Whereas in the calculation over here, it's saying that it should be less contingent liabilities net of tax. So that's the fourth issue. So for added, not subtracted contingent liability. What about the contingent liability again? Because I remember seeing up here that due to adverse developments in the case, Kilconda decided to settle the claim with its competitor and paid damages of 500k. So really, that's an adjusting event because it's something that was in existence at the reporting date, and it's something that we actually have to go back and amend in the reports as well. So this current draft goodwill calc only has 300k less 30% tax, but in reality, that contingent liability should be the 500k net of tax. So it should be 500,000 times 0.7 should be 350,000, not the 210k. And then finally, the other change, this is probably enough, but just to be careful, the final change just be inventory, because we flagged this before about how all of the assets need to be reported at net, but then adjusted up to fair value when you're doing your goodwill calc. So it says in here that everything except for inventory is at fair value, but there's no adjustment in here for the fair value of inventory. So that's pretty much it. That is how you get 10 out of 10. Obviously, you're going when you actually write your answers, it's going to have to be more comprehensive than that. I would recommend doing a table where you got 6 items, 6 identifications, and then 6 explanations. So including like a paragraph on each, including maybe the recalculated number. That's basically how you calculate it. So moving on to part B. Let's have a look at the question. So prepare the consolidation journal entries relating to the additional information presented above for the year ended 30 June 2017. Show all workings. You are not required to prepare any journal entries for the non-controlling interest. Okay, so it's a consolidation journal entries, accounting for subsidiaries. All right, so what we're going to do is we're going to bring up the exam Bible, skip to the top, then go to accounting for subsidiaries. And here we have all of the key journals that we're going to need. All right, so for the accounting for subsidiaries journals, there's a lot of journals. I've said this before, you don't need all of these. This is for those rare situations where you've got an exam question which is really long, 20 marks, and it's all on accounting for subsidiaries. This is only 10 marks, so it's pretty high level. So what it's doing is only selecting a few different transactions. Generally, they're just going to be the intragroup transactions, and because company A now owns company B, any transactions between the two are effectively the same company. We need to reverse them out when we do consolidation, because that's like me selling something to myself, basically, which, it's not real. It's duplicating my revenues, duplicating my expenses, it's making my EBITDA, my profit look bigger than it is. So we can skip through all this stuff, right? We don't need to reverse goodwill. We don't need to reverse adjustments to fair value because it's not in this question. We don't need post-acquisition journals. That's not in this question. It might be in another question, but not in this one. We don't need elimination of investment asset, but we do need this one. Eliminate intragroup transaction balances. And this is quite common. Like when you do your accounting for subsidiaries, most of the questions and the journals that you need are in this one, 5. Eliminate intragroup transactions. Same reason I said before, you don't want yourself to link to yourself, right? So you want to remove that. Okay, so first one is sale of machine. Sale of machine is PP&E, sale of PP&E. So have a look through here. We've got sales, we've got unrealized profit in closing inventory, we've got unrealized profit in opening inventory, we've got intragroup payable and receivable, we've got unrealized profit from intragroup sale of PP&E. That's what we need right there. So the journal that we need is going to be this. Okay, so we need gain on sale of PP&E. That's reversing it out. Plant and equipment. Cum, depend, PP&E, and then DTA, and then income tax expense. And then our description, we can just copy what's in the thing to eliminate intra-group profit from sale of PP&E. Eliminate tax impact and reinstate original accumulated depreciation. So it's exactly what you need to type. Now in terms of the numbers, this one, plant and equipment, is just the difference between accumulated depreciation and the gain on sale of PP&E, and then that just equals that. So the only thing we need is the gain on the sale of PP&E. So the gain on sale of PP&E is going to be this number down here, 70k. So we're going to go 70 to reverse that. And then the accumulated depreciation is 50k, it says over here. 50,000. So 50,000. And then the plant and equipment is just going to be 20,000 credit. Cool. Now the DTA, how do we calculate that? So DTA is calculated as CC. So I guess logically, it's just going to be, it's just going to be the gain on the sale times 30%. There we go. That's what the, and we want, yeah, that's it. Pretty easy, right? Just follow the template. Now, we also need to recognize the journals down below it as well, which is to adjust for depreciation on the transferred PP&E. So if we go back to book 1, and they've even given us like a table here to help calculate the depreciation cost down here. So put the journal here. Cum, depreciation, PPE, dep expense, income tax expense, DTA. Okay. Description is to adjust the depreciation recognized by the group and the related tax effect. I mean, even I don't really understand perfectly what's going on. I just follow the template and it gives me, you know, a really good mark. So it's all that matters, right? Okay, now let's put in our working over here. So we've got the original cost of the asset. So that's going to be, actually, let me just type out the table first. Depreciation to date of transfer, carrying amount at transfer date, sales proceeds, gain on sale, tax impact. so here's our little table up here so we can fill in our journal. So first of all, it's basically just the difference between the depreciation to date and the carrying amount at transfer. So the original cost is equal to 320, I think. Cost 300, no sorry, 300,000. 320, no it's 320. 320. And then the carrying amount to date is 50,000, and then the depreciation to date should be that, which is the 320. Its effective life is 40 months, so we can divide it by 40, and then times that by the number of months they've held it. So from November, 1st of November, nope, never mind, it was from should be 8 months. Is that right? So they've said they've recorded 7 months straight line depreciation. That's to 1 November, and then we're doing it 1 more month to December. So yeah, should be 8 months. I think that's right. So times that by 8. So we get 64,000, and then the carrying amount's 50,000. The difference between the two is basically our adjustment that we need to make to depreciation. So if we refer back to our journal templates, we're going to go debit equal 14,000, credit 14,000 for the expense because we're reversing it out. It's the opposite of what we'd normally post. And then the income tax expense is that just that times 0.3, and that's equal to that. Cool. That is okay. So that's 1 done. Now we've got to look at number 2, which is intragroup sales. So during May 2017, Kilcunda made sales to Otway totaling $200,000, which was at Kilcunda's cost price. That makes it easier for us. Otway paid Kilcunda for the inventory. Kilcunda would normally charge external customers $280K for these items. Otway sold this inventory for $290K to external customers. Okay, so for intragroup sales, we want to go back up here. So the first one. So all we need to do, thank goodness because they sold it at cost, otherwise we'd have to do these adjustments over here for the unrealized profit in closing inventory as well. So this makes it a lot easier for us. All we have to do here is just go, have we got the date right as well? We're doing 30 June, so these should all be 6. So let's just correct those. It's year end 2017, 30 June 2017. So just correct those dates. It's not super important, but if you don't get it right, you're going to lose marks, so just make sure you're checking that stuff as well. So this one's really easy. All you have to do is go sales revenue and then cost of sales. That's it. And copy the description to eliminate intra-group sales. Now, if they didn't sell it at cost, we'd have to do these journals down here as well to eliminate the unrealized profit inventory. So all we have to do here is go 200,000, and that's it. That's part 2. And then for 3, intragroup financing. So there's a loan and a payable amount. So if we bring up this one and look for intragroup payable and receivable. So first of all, we have to reverse out the payable and receivable. We also have to reverse out any income associated with it as well, because there's a loan there and there's also interest there as well. So first of all, let's reverse out the payable. So intragroup payable, and then intragroup receivable. So we can reverse that out. It was 500. Is that right? Yep, $500,000. And then the only other thing that we need to do, which is very similar to this sales revenue, is just reverse out the interest. So there's going to be interest, reversal of 10,000 revenue, interest, reversal of 10,000 expense. Interest. So they definitely made it easy for us. This wasn't a difficult, they could have made it a lot more difficult for this question. And that's it. And that is how you get 10 out of 10 on question 4 part B and 20 out of 20 on question 4 of FIN317. And that's the end of the exam, getting 100% on that exam.